Okay, good morning students. Welcome to our next video. This video will focus on chapter 9 or new topic that we haven't done before, which is value added tax or VAT. I have briefly spoken about it when we went through all of the theory chapters, but we haven't done any calculations regarding the VAT. So this first video on VAT is just to explain to you some or give you some of the backgrounds of how VAT came to be and how VAT is calculated, what the differences is between the types of VATs and how VATs are classified, etc, etc. And then at the end of this video we will just have a look at a quick example of how we do the VAT entries in the general ledger account. So we're going to do some more general ledger entries now, just including VAT in the transactions. We'll have a look at the two ways of calculating VAT for the difference between inclusive and exclusive VAT. The next video will then deal with actual general ledger, set of general ledger accounts where we include VAT in all of the transactions where applicable. And then we will also look at the other ways of or the other way of asking a VAT question, and that is by using the VAT table. So there will be 3 different videos for VAT or the value added tax, and like I said, this first one is simply just going through the explanation of it, the types, the calculations, etc. Okay, so what is VAT? VAT is the value added tax system. It's a consumer tax system that was introduced in South Africa many years ago. There has been many different percentages for VAT, ranging from 10% right through to where we are now, 15%. The latest change happened in 2018 when VAT was increased from 14 to 15%. For most of us, we lived in the era where VAT was 14%. When I was very young, there was 10% era, but most of us have known VAT to be 14%, and then it changed to 15% in 2018. Now remember that the government or the Reserve Bank has the right to change the VAT percentage at any given time if they see so necessary. So when you do VAT calculations, don't just be focused on I'm going to use 15% or I'm going to use 14%. It can vary. So make sure you read the question carefully. You must be prepared to use any VAT percentage when you do your calculation. So read carefully what the questions say, what VAT percentage is applicable to this time period when you are doing this entries. So be on the lookout for that. Don't just assume that it's going to be 15% all the time. Now, why who controls the VAT system? The VAT system is controlled by the South African Revenue Services, or SARS as we know them. They can collect VAT, but they can also pay out VAT depending on the circumstances of the person. I'm going to show you how we get to VAT receivable and VAT payable later on, when you will get back and when you have to pay over to SARS. Okay, first let's see just how the VAT system works. To be part of the VAT system, to claim VAT and to pay VAT, you need to be registered as a VAT vendor. Now, currently, to be registered as a VAT vendor, you have to earn more than 1 million rand for it to be compulsory. So the moment your turnover, not your profit, not the money you put in your pocket, your sales, contract sales or your turnover, the moment that reaches 1 million or more than 1 million, it is compulsory according to law that you have to register as a VAT vendor. If your sales is between 50,000 and 1 million, so that bracket of 50,000 to 1 million, it is your choice. You have the option to register as a VAT vendor. You can do it if you want to. If you don't want to, you don't have to. And if your turnover or your sales is less than 50,000, currently you cannot register as a VAT vendor. So that's the 3 scenarios. Less than 50, you can't register as a VAT vendor. Between 50 and 1 million, it's your option if you want to register as a VAT vendor. And the moment you reach 1 million or more, it is compulsory for your business to register as a VAT vendor. Now, the moment you register as a VAT vendor, you need to understand the difference between input VAT and output VAT. Input VAT and output VAT. That is the principle on which we're going to base our calculations for VAT to see whether VAT has to be paid over to SARS or if VAT will be received from SARS. Okay, so let's have a look at input and output VAT. To understand the process of VAT, you need to understand the difference between input VAT and output VAT. So firstly, what is input VAT? Input VAT is the VAT paid on all purchases, very important, of goods and services. So when you buy something from your suppliers, from the people supplying you with any type of product, it's a purchase. That is input VAT. So you're going to record all the VAT on purchases under input VAT. This VAT can be claimed back from SARS, so this is receivable from SARS. Then output VAT. Output VAT is the VAT that is paid on all the sales of goods and services, and this VAT must be paid over to SARS. It's payable. You collect it on behalf of SARS when you make a sale. So if we look at this picture, we have two types of transactions. It must either be a purchase where you paid for something, or it must be a sale where you received something. If it's a purchase, you can claim input VAT on that. You can get it back from SARS, the money that you paid for the VAT. If it's a sale, that person paid the VAT over to you, so you've collected it, that money must be paid over to SARS. So input VAT is receivable, output VAT is payable. So how would I know at the end of my period whether the VAT is payable or receivable? Am I going to get something back, or must I pay over to SARS? So at the end of the period, we need to calculate that amount. We need to calculate the difference between input VAT, all the VAT on purchases, and output VAT, all the VAT on sales. Okay, so here comes a very important part. If the input VAT, so the VAT on purchases, is more than the output VAT, the VAT on sales, the difference will be receivable from SARS. But if the output VAT, the VAT on all your sales, is more than the input VAT, the VAT on all your purchases, that amount will be payable to SARS. Now, obviously, businesses sell goods at a profit, so the selling price will more than likely be more than the cost price. Otherwise, it's not good business. So very often you will find that businesses, the output VAT will be more than the input VAT, and therefore they have to pay over to SARS. But that's just a calculation. It's a possibility from month to month that it can differ. If you purchase more goods this month than you've sold because you bought in bulk for long term, then your input VAT will be more than your output VAT, and you will be able to claim back from SARS. Now, with that being said, VAT is not charged on all supplies. We get three types of supplies, or three types of categories under which we're going to divide our VAT supplies. The first one is standard rated VAT items. That's the one that you'll encounter most of the time. This is items on which input VAT and output VAT will be charged at the standard rate, and currently in South Africa that's 15%. So items on which VAT is charged, those are standard rated VAT items. So that will be most of your expenses if you pay for advertising on telephone account, or water, electricity, or stationery, or when you buy materials, or when you buy vehicles. Anything that you purchase, or any items, most of the items that we deal with will fall under standard rated VAT items. The second type is a zero rated supply. So zero rated supplies, there is 0% VAT charge to the end consumer. So the last person buying this product in the chain. So if you go to the supermarket and you buy it from the chain, zero VAT will be charged to that person. It's zero rated because it can change. It is possible that the government can decide to add a levy on those items, but currently they are zero rated. They include fresh milk, vegetables, maize meal, brown bread, etc., etc. All those things are zero rated. And then lastly, we get to exempt supplies. Exempt supplies means they are exempt from VAT. They are not taxable at all to anyone. It's not only to the final consumer where it will be zero rated. There's no VAT on those items at all. What are those items? When you pay for your fees here at the university, your educational services, those are currently VAT free. Or if you pay for your primary residential rent, the house that you stay at, that rent is free. It's not when you rent for business premises. Unfortunately, there is VAT on that, but your primary residential rent will be VAT free. So there's some items that is exempted from VAT. Another one that will be zero rated is salaries and wages. We don't pay VAT on those. So that's the three types of supplies that we get. All the items that we buy or sell must fall within one of these categories, so we know whether we can calculate VAT or whether no VAT should be calculated on those items. Okay, so that's just some background on the VAT and the type of VAT items that we get. But how do we actually calculate VAT? There's two possible calculations that we can do for VAT. Items or invoices can be given to you at the price including VAT or excluding VAT. So inclusive or exclusive amounts. Now it can differ from question to question and from business to business. Obviously, some people will include the VAT on the invoice, others will exclude the VAT and tell you to add VAT. So make sure that you read whether the invoice is inclusive or exclusive of VAT, or whether the request sent to you is for inclusive or exclusive VAT. If the amount is given to you exclusive of VAT and you want to calculate the VAT, you're going to take the amount times by, because we are now using 15%, the VAT percentage over 100. So if it's 15%, 15 over 100. If it's 14%, 14 over 100. If it's 10%, 10 over 100. So take the VAT percentage over 100. If the amount is given to you inclusive of VAT, so the VAT has already been added, the amount you see in front of you already includes the VAT. To get the VAT out of that, we're going to take that amount times by the VAT percentage over 100 plus the VAT percentage. So it's 15%, 15 over 115. If it's 10%, 10 over 110. If it's 14%, 14 over 114. So that's the two calculations. You have to see whether the amount that you received is inclusive or exclusive. And once you know that, you'll know what calculation to do to get to the VAT amount. That VAT then needs to be recorded in the VAT control account, the general ledger account, the T accounts that you've been doing all the time. The left-hand side we know by now is the debit side, and the right-hand side is the credit side. So that all still works the same for VAT control account. All of the purchases that you make, the VAT included in those amounts, will go to the debit side. The debit side is the input VAT side for all of your purchases. And all of the VAT you gathered on your sales that you've made during the year, or any income that you have, those will be on the credit side of VAT, the output side. So input VAT side is on the debit side, the output VAT is on the credit side of VAT. Okay, so I've put together a little example just to show you how the recordings will work for VAT. There's 3 transactions over there. So I'll just show you an inclusive and exclusive and then a zero rated item. How do we deal with that? Please, in your books on page 213 to 228, there's examples of all the different types of transactions: credit transactions, cash transactions, sales, purchases. You can go and have a look at exactly how the VAT entries are done for those. But these examples that I will do with you now will give you a very good idea, and you should be able to see how the VAT works. So there's 3 transactions that we're going to go through. Let's have a look at the first bullet. It says bought building material to use in building projects for the business, 3450. And they tell us that amount of 3450 is inclusive of VAT. We received an invoice for this transaction, and VAT is calculated at 15%. So let's just see what we can see from that transaction. I bought material, and because I received an invoice, I know it's a credit transaction. So I have building material and I have accounts payable. The amount is given to me inclusive of VAT, so I know what calculation I have to use to get to the VAT, and they also tell me that VAT is 15%. So therefore, because it's inclusive, I'm going to take the 3450 and I'm going to times by VAT over 100 plus the VAT percentage, so times by 15 over 115. That tells me that included in that 3450 is VAT of 450. So the 3450 is made up of material of 3000 and then 450 for VAT to make up the total inclusive amount of 3450. Okay, so now how would I go about recording this? I purchased material to the value of 3000 and the VAT on that is 450. So the material excluding VAT figure is going to go to the building material account. So debit building materials, because it's an asset. Asset increases on the debit side. So debit building material, it's a credit transaction, so therefore accounts payable. Debit building materials, credit accounts payable with the 3,000. So we've now entered the amount without the VAT, before the VAT, exclusive of VAT. We still need to enter the 450 for VAT. The 450 still needs to go to VAT. Now I'm going to ask you, the VAT control account, we just went through it. There was a debit side and a credit side, and an input side and an output side. Was this transaction that we just did, was this a purchase or was this a sale? We bought material, so therefore this was a purchase. So therefore this will be input VAT. What side of the VAT control account does input VAT go to? Input VAT goes to the debit side. So on the debit side of VAT, debit 450, it's a credit transaction, so therefore accounts payable. If I debit something, I need to credit something else, double entry principle. So I'm going to credit accounts payable with the VAT amount of 450. So if we now look at this transaction as a whole, the exclusive amount, the amount before VAT, went to building materials. The inclusive amount, the building materials and the VAT, both went to the accounts payable account. So the inclusive VAT amount of 3,450, and then VAT went to the VAT control account. My debits match my credits. I have debit of 450 and a debit of 3,000, so that's 3,450. I have a credit of 3,000 and 450, so 3,450. I'm still in balance. So what you can see from this is exclusive, the amount without VAT goes to the material account. VAT obviously goes to the VAT column, a VAT control account. What side? Determine whether it's a purchase or sale. This case was a purchase, so debit side. And then the inclusive amount, both of them. So the building material amount and the VAT control amount goes to accounts payable for 3,450. The second transaction, I build a garage for S. Dobson and he paid in cash. So I have a sale, not a purchase now. I'm dealing with a sale. It's a cash sale. The amount exclusive of VAT is 10,000. The VAT is 15% and the cost of sales is 6,000. Okay, so let's see what we have now. I'm dealing with a sale because I'm selling something. I built something for someone, so I have a contract sale. I have the amount exclusive of VAT this time. So before VAT is added, and I know that 15% is charged. So how do I calculate VAT if it's exclusive? I take the amount times by the VAT percentage over 100. So in this case, 15 over 100. So the VAT will be 1,500. The exclusive amount before VAT was 10,000. I still need to add VAT of 1,500 to that amount. So the inclusive figure will be 11,500. Okay, so how do I make this entry? I'm now dealing with a sale, so contract sales. And it's a cash sale, so bank. I made a sale for 10,000 with before the VAT. So the exclusive amount goes to bank, 10,000, and the 10,000 to contract sales. So there's my debit and my credit. But they're going to pay the VAT amount as well. I'm collecting the VAT on behalf of SARS. So I still need to add the VAT of 1,500. I'm going to ask you the same question. What side of the VAT control account will this go to? That's what you must ask yourself. Are we dealing with a purchase or a sale? This time a sale, so we're dealing with output VAT. Output VAT goes to the credit side of VAT control. So on the credit side of VAT control, the VAT amount of 1,500, it's a cash sale, so bank. You will see that always in the VAT control account, it's either accounts payable, bank, or accounts receivable, the account used to make the payment. So there's my credit of 1,500, debit bank 1,500. So the inclusive amount, the amount with VAT, the two entries, goes to bank account. Exclusive amount goes to sales, and then the VAT portion to the VAT control account credit side because it was a sale. And that's what you'll do for all of these accounts. See whether it's a VAT item, calculate the VAT, see if it's inclusive or exclusive, calculate it, and you should be fine. Okay, there's also a second portion to this, cost of sales of 6,000. We know that whenever we make a sale, we need to record cost of sales. So we will say debit cost of sales and credit building materials. But what about VAT? Mental note, important, make it in your head. There is no VAT on cost of sales. There is no VAT on cost of sales. Why is that the case? When we bought the material in the first place, it was a purchase and we charged VAT on that. It's in the storeroom, it's been sitting there. We simply now use it to complete a job. We don't buy it again when we record the cost of sales. We simply record the amount so we can calculate the profit. So there's no VAT on cost of sales. So the cost of sales will be a normal entry. Debit cost of sales 6,000. Credit building materials 6,000. That's a normal entry. No VAT on that. Lastly, third transaction, I paid the weekly wages for 6,000. Now we have a problem. We have to think carefully. Is this a VAT item? Is VAT charged on wages? No, it's an exempt item, zero rated item. We cannot charge VAT on this. So we only going to record it as per normal. Pay the weekly wages, so credit bank and debit cost of sales wages. Debit cost of sales wages 6,000, and then we still have to add the bank entry. Pay the weekly wages, debit cost of sales wages, credit bank with the 6,000. No VAT because it's a exempt item. There's no VAT charged on wages. So that's just a short summary explaining all of the VAT items to you and how it works. Remember to see whether the amount is inclusive and exclusive. That will determine your calculation. Make sure you're dealing with a standard rated item when you calculate the VAT. If it's exempt or zero rated, then obviously there's no VAT. And then just make the recordings. Make sure your debits matches your credits so that you stay in balance.